key themes for the reporting season just gone was that it was another solid reporting season following on from the mid-year reporting season. So we've saw EPS growth for industrial companies, around mid-single digit, but we saw even a stronger probably lift overall in dividends, and companies are giving investors what they want, and that is fully franked dividends. And so that was the big theme from the results. The strongest results came from those companies exposed to the building sector here in Australia, the residential in particular market. We saw some good results from the banks, a full year from CommBank and then quarterlies from most of the others. And also the resources companies, the big ones in particular, BHP and Rio, we saw very strong results as they focus on productivity and cash flow. Results that outperformed our expectations included Boral, exposed to both residential and construction markets, and we know that those areas in Australia are experiencing good growth at the moment. Coming into that, Harvey Norman, filling up these new houses and construction with goods. Harvey Norman had a very pleasing result as well. Commonwealth Bank, and again another very solid result, and again exposed to the residential mortgage boom that we're sort of seeing currently. BHP and Rio outperformed expectations. However, they are really hostage now to the forward-looking iron ore price, which, as we've seen, remains under significant pressure. Relative to history, the market is expensive. However, with interest rates at record lows, it can stay this way. It really now depends on whether the profit growth forecast for the next 12 months can be achieved. We're looking for about a 10% growth in profits next year, which is certainly achievable, but it will depend on the sort of benign conditions that we're seeing in the economy continue on. Stocks that we think are reasonable value at the moment include Horizon, the Queensland coal operator, Boral, which is exposed to the residential and construction markets, which we think are poised to grow for the next few years quite nicely. And linked to that, stocks such as JB Hi-Fi, which is certainly a slowing growth story, but still a very strong franchise in its own right. And another business we quite like is Tats Group, which owns and operates most of the lotteries around Australia. Quite a steady business, not as cyclical as a lot of companies are here in Australia, and well run and with opportunities to move down a more digital path, and meanwhile pays a 5% fully franked dividend. So now that reporting season is out of the way, we're being hit with a plethora of new floats. The investment banks are coming straight back in with a long list of new floats. Probably the biggest and first off the rank will be another healthcare, aged care company called Regis. This industry has become very hot amongst investors with the recent float of Japara, which did quite well. And so there's a long list of their competitors looking to float. The big one for this year, which we expect will come before Christmas, will be Medibank Private. This will be a $4 billion plus float, and this could be quite an attractive opportunity depending on the price, which is unknown at this stage. But privatisations generally, you have a good probability of doing well over time if you're a patient investor. I think as long as interest rates remain low, the outlook for the equity market remains benign. There's still a lot of investors keen to generate income from the market. I think that's quite supportive. Companies are recognising that and are focusing on paying out fully franked dividends to the maximum of their ability.